Well, thank you everyone for attending tonight's asset protection webinar. Tonight we're going to be talking about asset protection for the real estate investors and how real estate investors do asset protection. There is so much misinformation, and so it's really tough to get really good advice. And so we're going to cover some very basic principles and then hopefully invite you to the 3-day summit where you can meet face to face with some of the best experts in the nation on how to protect your assets. If you're new to us, there's a lot of new people tonight, and so this is a part of an ongoing series that's been going for almost 10 years now. A couple weeks ago we had Roberta from iPlan Group talking about they're managing thousands of accounts, and she gave some really good examples of what other people are doing with their IRA accounts. Steve Ruff, president of CostSeg, and what an incredible webinar that was on May 6th on cost segregation and the new CARES Act. And I'll touch on a couple principles, but it really encouraged you to go back and listen to these. They're all recorded on Protect Wealth Academy's website. Next week, we'll have Scott Estel, former senior trial attorney from the IRS, talking about tax strategies for real estate investors. And so, again, I'm going to hit a couple ideas, but I'm going to leave the bulk of this to next week when Scott is on. Aaron Adams is lined up for the 23rd to talk about real estate investing. So don't miss the upcoming webinar series. We also have 3 upcoming summits, and I want to talk to you real quick about Phoenix. I was down in Phoenix this last weekend. I went to the hotel where we'll be having it. They've already had a couple events, and they're starting to get used to getting back into holding events. The first day, people arrived with masks and gloves, and by the end of it, I didn't see anybody. I was wearing masks and gloves, and although we want you to be safe, we really are. The hotel has taken a lot of precautions. We're going to proceed, but in this summit, we're going to be very limited to the number of people we put into the room. If you have not registered, we encourage you to do that right away. If you have registered, we need to confirm that you're coming, and so you should be getting a call or emails from us within the next couple days, because the number is extremely limited. We can't put 200 people in a ballroom anymore. That's not safe for everyone involved, and so we really need confirmation that you'll be coming. If you can book at the hotel, we've got an incredible $99 room rate that will confirm your registration. But we'll be asking for other things to make sure. What we can't have is a lot of people who signed up 3 months ago, 6 months ago, before the COVID-19, say, yeah, I'll be there, and now we hold a space for you, but you don't show up. We can't do that this time. There's too much at risk for everyone. And so expect, if you've registered for that, it'll be at the Hilton Airport Phoenix Hotel. It's a great hotel. It's like, I don't know, 3 or 4 miles off the airport property. Free shuttle to and from. We couldn't have negotiated a better room rate for you. But if you have registered for that, make sure that you're confirmed for it. And again, we'll be contacting you. This is where we're bringing some of the best of the instructors from all over the nation. We've got some incredible attorneys, instructors lined up to teach this. If you'd like a sample agenda, go to our website, protectwealth.com. And for those of you who have signed up for the cruise in December, we're still kind of putting that on hold. You go ahead and continue to register if you'd like. Book your travel, but know that August 1st, we can still, up until August 1st, we can still get out of it if we don't feel like it's going to be safe for everyone involved. So that's kind of our upcoming events. Before we talk tonight, there's going to be a quick little disclaimer again. If you've been on our seminars or webinars, the disclaimer is always the same. What we can teach in a webinar setting is our general principles. I'll try to be very accurate. I'm going to try to be real clear, but how they apply to you, not every principle I discuss will apply to everyone tonight. So we we encourage you to come to the summit where we can sit down with you one-on-one, or at least discuss these principles with a professional. So with that, let's get into real estate investing. And Al, would we consider doing this seminar remotely? And yes, we are considering all options at this point. So, all right, so let's move on. Is it a great time to be in real estate? Oh my gosh, there is so many tax advantages right now. The real estate market continues to climb. My personal opinion is that there's not a real estate bubble. America is too, there's a housing shortage, and especially for low income housing, middle income housing. The high end stuff, I haven't personally invested in that as an investment tool, but it's a great time to be in the real estate market. And let me give you a few little tax ideas about why it's so good. You've got a real estate investor who's the president of the country, and this Trump tax law, the CARES Act, everything has pointed and given great advantages for real estate investors if you're paying attention to them. For instance, right now, all rent could qualify as business income. 20%, the QBI tax, 20% of all rental income, we don't have to pay taxes on it. But here's the critical thing, and that is you have to treat it as a business. When this came out, it was like, woo, 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 woo. Yeah, I don't have to claim 20% of my rents. That's good, but if you're not running it as a business, it will be disallowed. And we're finding now some clarification from the revenue rulings on this. You have to run this as a business, which means it's probably a good idea to track your hours. It's probably a good idea to have an LLC or a corporation that's managing separate bank accounts, keeping expenses, carry liability. We have to treat this as a business, not willy-nilly, I just put all the rents into my own personal account and I pay the bills out of my personal account. And this sole proprietorship stuff, I'm not sure is going to qualify under an audit. We really have to take advantage of the QBI discount. You really need to run your real estate as a business, and take a look at those suggestions that are on the screen. All right, another thing is a lot of real estate investors don't understand real estate losses. So I put in a couple slides here that may help. If you saw me this last weekend, I'm sorry, a couple slides are going to be a repeat, including these next two. I've got a little residential assisted living house that's 5 doors down from me. It's up for sale, not the business, but just the real estate. So if the tax impact of this, and I'm going to kind of break it down, it's let's say the real estate alone is $500,000. You won't be able to depreciate the land. That's an investment, but it's not depreciating. If the building burns down, the land is still good. The building, though, what we could do is we could take that 350 shown on your screen, divide that by 27 and a half years. Now, I don't make up that number, the IRS does. If it were commercial, it would be 39 years. But that's a set number of years, if we divided that by 27 and a half years, it ends up being showing as a loss in real estate, 12,727. Now, let me be clear, you didn't really lose money. Assuming that this was the only transaction and there were no rents, no other expenses, this is what we did. We put it in service by the end of the year. And this would apply to 2019, 2018. Okay, so you show a loss in real estate. What can happen with that loss is that can go to offset any other investment income that you have, or it could go to up to $3,000 in W-2 income to offset that. And then if you've got a bigger loss than that, it rolls forward to take care of gains in the future. Okay, so I like the idea of having a $12,000 loss. Again, you didn't lose money, but on paper, I've got that loss, so I don't have to pay income. I don't have to pay taxes on the first $12,000 of income that I earned. All right, but again, remember that this was turnkey. I bought it, it was ready to go. I didn't have to put any improvements into the building at all. I had $12,000 loss. But let's do this a little bit different and still a $500,000 all-in cost. But let's say I bought it, it's going to be a fixer-upper. I'm going to buy the building and the land for $250,000, and then I'm going to put some money, half or $250,000, into repairs and improvements. You will want everything in life to be a repair. The IRS wants you to claim everything as an improvement. I'll show you why in just a minute, because the tax impact of this, I still can't deduct what's in green, the land. That's an investment. I can't depreciate that. But anything in white, the building and the improvements, I can spread out over 27 and a half years. Now, if you look at that and you go, well, I really like the $12,000 loss better. I know, 5,000 is not as sexy, but what happened to the repairs? The repairs, if I put this in service by the end of the year, all of that repair deduction I can claim right now this year. Now I've got $155,000 loss in real estate. Ooh, that's really cool. That wipes out, again, all other investment income up to $3,000 of W-2 income. And if I can't use it this year, I roll it forward to next year and next year and next year. Now, the difference you'll ask is, what's the difference between a repair and an improvement? Improvements would be like, I added a bedroom, we added a fireplace, we upgraded from your regular countertops to nice granite countertops. That would be an improvement. Of course, you want everything to be repaired, so I can deduct it right now. And you and your accountant are going to have to figure that one out, whether it's a repair or whether it's an improvement. And this is where I'm not going to get involved with that one, but you understand that the difference for the tax side can be very, very huge. Now, if you can't get it in service by the end of the year, then all those repairs would go into next year's tax return. All right, so those are real estate losses. And then another part of the Trump tax deal is anything that goes into that real estate. These would be furnishings, equipment. This would be your air conditioning unit. This would be your furnace. This would be water heaters, anything like that. Between expanded Section 179 deductions and bonus depreciation, you should be able to deduct almost everything that goes into an investment property, up to $1 million. Now, the other change is that it doesn't even have to be new equipment. It could be used equipment. And then a couple weeks ago, we had, again, Steve Ruff come in and talk about cost segregation. And what he suggested is anybody with real estate right now, anybody with existing real estate other than your home, if it's investment real estate, we look at pulling your depreciation schedule, which your CPA, which your accountant probably spread out over 27 or 39 years. And if we could speed that depreciation schedule up by bringing in a cost seg analyst, an engineer, and split up this and go, you know what, but the carpets are going to depreciate at 5 years, 7 if they're commercial, the cabinetry, the blinds, we're going to speed that 27.5 years, we're going to give it to you in the first 5 years. All of those things. And then we look at land improvements, and we look at parking lots, gutters, storm grades, irrigations of trees, shrubs. We're going to put that on a 15-year. The whole idea is to give you a bigger tax deduction right now this year, so you got more money to invest in real estate. If you did not listen to that webinar on cost segregation and you have existing real estate, I strongly encourage you to do that. Now, Steve's a little bit nerdy. He's very analytical, but oh my gosh, what an incredible webinar that was. Encourage you to go back to that. And then, as part of the CARES Act, our Congress put in a brilliant move for real estate investors. And I don't know, this didn't hit the national news, but it's clearly in there. If you have, well, a summary, persons who qualify as real estate professionals this year, which means that you put in 750 hours, you can document those hours spent on real estate investing. And it has to, that 750 has to exceed any other W-2, any other business activities. But if you can qualify as a real estate professional this year, then you can carry back your net operating losses up to $1 million to offset all W-2 income, all 1099 income, all investment income over the last 5 years. Well, so any taxes you've paid in the last 5 years, and I don't have to go back and amend my tax return. I fill out one form and I get all the money back that I've paid in taxes over the last 5 years. Now, this expires at the end of this year. Now, that's the way the law is currently written. I don't know if Congress is going to expand that, but this is like an ooh baby. This is a huge deal for real estate investors to go back and if you've got a net operating loss this year and you're a real estate professional, I can wipe out all the taxes that I paid in the last 5 years, or up to 5 years. I don't know. Again, it's up to $1 million. And then if I still have a bigger loss than that, I can carry that forward to future years. This is a game changer. And I'm not sure if your accountants are teaching you this, but we'll cover this at the summit in Phoenix. And you can also go back again and listen to that webinar that Steve Ruff talked about on cost seg analysis, because he talked about this. And I think Scott Esther will probably cover this as well. Bottom line, it is a great time to be in real estate. However, it's also a risky time to be in real estate, because lawsuits, as the economy teeters, as people lose their jobs, it's very common and almost always follows the pattern that lawsuits increase. And who do most people want to sue? I don't know, whoever's the deep pocket in their relationship. If they're renting from you, you may not consider yourself to be a deep pocket. I've only got a little equity in this investment property, but you do have something that your renters don't have, which is equity in real estate. And so in this relationship, you become the deep pocket. I was down, it's probably been a couple of years now. I was down in Louisiana and talking to the Louisiana Convenience Store Owners Association and oil distributors. I don't remember the name of the association, but it was close to that. And we had one guy who owned 3 convenience stores, 5 car washes. And at any one time, he says, I never have less than 20 to 25 lawsuits going on at any one time. He had a picture of somebody throwing their soda on the floor, looking around, seeing, make sure nobody was watching, come in and slide as if they were sliding into third base. And then they get down and they look around again, bang their head on the floor and go, ow. And he says, I can't win that lawsuit. The insurance company would rather settle than and just pay them whatever they wanted rather than fight this, because it's not worth the fight. It's a different world that we live in. And let me kind of go over what I consider to be some of the biggest threats for real estate investors. The problem, one of the problems that you have as a real estate investor is all the seminars out there is how to make money, how to flip houses, how to do real estate deals. They're teaching offense, 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 but nobody is really saying, yeah, but here are the risks. And so I'm going to spend just a couple minutes on this, and then I'm going to cover the rest of the time on solutions. I don't want to scare anybody. I don't, but you need to know what the risks are. So here on this screen, I've listed what I consider to be the major sources of lawsuits for real estate investors. The number one is keeping your tenants safe. If your tenants get injured on your property, hopefully you have good insurance. Hopefully you've you've sucked out as much equity as you can out of the properties. Hopefully you've got good entity structuring, so we've isolated that risk to that one property or a small group of properties. But hopefully a lot of things, but we always want to isolate. We want to make sure that tenants are safe. If there's an assault on the property, are they going to come after the 45-year-old guy that did damage, but he doesn't have any money and he's living in his mom's basement? Or are they going to come after you? Again, you're the deep pocket in that relationship. And so any assaults, so most likely there will be a lawsuit. And if you have insurance, we're hoping the insurance will fight that battle for you. But if there's holes in the insurance policy, mold and mildew, yeah, that's not covered. Lead-based paint, oh yeah, that's not covered. Acts of God, yeah, the criminal, the activity, that's not covered. The insurance companies are going to do everything that they can do to exclude the claim, still keep taking your premiums, but not pay the claim. So that's a major source of lawsuit. Management problems, maintenance concerns. I don't have time to go over everything, but joint and several liability. If they find that you are 1% liable in a lot of states and jurisdictions, 1% liability. Yep. Yeah. Somebody else was 99. Yeah. Yes, I understand. But you probably could have fixed the lights in the parking lot, and the jury says, yeah, you're about 2% liable. In a lot of states, like California, any liability means you have joint and several liability. You get to pay 100%, even though you were only at 2% at fault. And there's quite a few and an increasing number of states that are taking on the joint and several liability theories. An implied officer. Oh, my wife wasn't on any of the paperwork, but she signed a couple checks. Yeah, now she's an implied officer because you really didn't keep up the minutes, meetings, resolutions, the formalities well. You kind of let spouse kind of get involved. Statutory liability is the scariest one for me, because that says by default, no matter what happens, again, mold and mildew, a chemical spill, lead-based paint, all they have to do is show that those things occurred on the property, and there's no time for defense. You will fix the problem, and you will clean it up, and they will come after personal assets. And it shouldn't be a surprise to anybody that insurance may not cover you. Those are what I consider to be the major threats to real estate investors on the liability side. And one of the problems is we get some really stupid advice from your accountants, from attorneys. Remember that less than 1% of the nation's attorneys specialize in asset protection. That's a statistic from the American Bar Association. 0.6% of the nation's attorneys, and almost 50 times that is the number of personal injury attorneys out there coming after you. So the odds are stacked against you. And then you're getting really stupid advice from your accountant. Don't ever listen to legal advice from your accountant, or sometimes even tax advice from your attorney. One of the things we do really well is bring kind of a combination of the best experts when we come to the summit. But one of the worst advices that I get, I hear from students all the time. I went to my accountant. They said I don't need any legal structures. That's just going to complicate my life. Just carry more insurance. Well, and let's say you go from $1 million liability policy to 5 million, just because okay, that way I'll be covered. Not knowing that having more insurance is going to paint a bigger target on your back. And if the insurance company didn't cover it at $1 million, why do you think that they would cover it at 5? A lot of people think, well, now I'll just have an umbrella policy that covers everything that I do. But not knowing that if primary insurance doesn't cover it, let's say there's an exclusion in the policy, in the primary insurance, an umbrella policy will never pay if the primary doesn't first pay. And so adding depth to the insurance never increases the breadth of the insurance. I won't say never, because sometimes we add more insurance that covers more things, and that would be okay. But just having more insurance is not going to automatically increase the more things that could go wrong. So carrying insurance, dumb idea. Just set up an LLC. Oh, I hear that all the time. What kind of LLC should it be? Should it be a manager managed? Should it be a member managed, single member, multi-member? Where should it be? Should it be in our state? Should it be in another? Should it be owned by another? Should I nest that LLC? And it leaves you a little bit confused. And most accountants can set up an LLC, but what does the operating agreement look like? Is it done by a really good asset protection attorney, or did they pull off a legal form off the internet? Just set up an LLC can be the most disastrous thing you do to hold rental properties. Or let's put the property into the trust. And this last weekend, again, I was down in Arizona, and I ran into several people that have multiple rental properties, all in their revocable living trust. And that is a great probate tool. When they die, the kids or whoever, the beneficiaries, will inherit the properties. It will avoid probate. But if there's a lawsuit here and now, the revocable living trust doesn't protect the estate from lawsuits. The fact that you can move the assets in and out, in and out, in and out all day long, if you have a judgment against you and you have access to those assets, the judgment creditor also has access to those. The revocable living trust is a probate tool. It is not an asset protection tool. Well, let's just hold the property in your corporation. But the corporation is, again, a tax tool, just like the trust is a probate tool. It was never designed, corporation was never designed for asset protection from outside lawsuits. Let's say you put all your properties into a corporation. It's really a dumb idea on the tax side. All taxable events are going to stay within the corporation, and moving assets into a corporation is like moving a mouse into an old mousetrap. You can get in, that's easy. Getting out is going to be a taxable event, most likely. And then the vulnerability of the stock. In 49 states, if I sue you and get a judgment against you, one of the assets you own in your personal name is stock in your corporation. I sue you, I get a judgment against you, I take the stock of the corporation, and now I own the investment properties. Not a good idea generally. And just use a single member LLC so that you don't have to file a tax return. That is true. Single member LLCs are disregarded by the IRS. But in 45 states, you put your properties in a single member LLC, I get a judgment against you, I can come in and take that house from you because there's no innocent parties. I'll talk about this in a minute, why single member LLCs don't provide charging order protection, but they don't. I can take the properties away from you. So again, we'll hit that. There's so many more dumb ideas, but those are the principal ones that I hear on a weekly basis. So let's talk about some solutions and know that a very basic fundamental thing is that the strength of your LLC is going to be determined by four things. The number of owners that you have, again, I'll get into that in just a minute, your state charging order protection, the operating agreement that you use, and the maintenance that you use If you set up this beautiful structure, maybe you hire the best, most expensive attorney in your neighborhood, set up a really good asset protection plan, but if you don't maintain it properly, it will not hold up to scrutiny in an audit or in a lawsuit. So those are the four things. Let's talk primarily about why single member LLCs don't protect assets. And the best way that I can do this is to teach you a little bit of history on asset protection. And the LLC statutes came from limited partnerships. Let's say there's a partnership that has 10 partners, and they all put in their $1 million or whatever their investment, and they're going along, they're investing in real estate, they're doing well, but Fred over here gets in trouble. He does something wrong, or he's accused of doing something wrong. Either way, he's in the middle of a lawsuit, and they're coming after the assets. Would it be fair if the judgment creditor was allowed to come in and take all the assets out of that partnership? The answer is no, because that would hurt 9 other investors. What if I don't take all the rental property, I just take all the rents? Well, again, that would hurt 9 people. 9 other innocent parties. Well, what if I just take over Fred's interest? Well, they didn't want the judgment creditor as a partner. They wanted Fred for some reason. And so the rule in most is I can't take the assets. I can't take the income unless it's distributed to Fred. And then in that case, I'm putting a charging order or a lien against his interest. My hand is on top of his hand in the event that there's distributions. And in a lot of states, I can't even foreclose on his interest. I can't take it away. Now, a lot of states don't allow, they do allow for a foreclosure after a couple of years. And that's why states are, I'll get into state specifics in a second. But now we come along with single owner LLCs. There's only one owner, there's only one member. And so in 2003 was the first time that I know that this was really strongly contested in the courts. Mr. Albright is in Denver facing in federal bankruptcy. He's set $2 million aside in a single member LLC. Single member LLCs have the same statutes, state statutes, as limited partnerships. So he's standing before the judge going, yeah, I'm going bankrupt in my life, but you can't touch this single member LLC, as all you can do is put a charging order against my interest and wait for me to distribute. Neener, neener, neener. And the judge looks at him and goes, you know what? I don't agree with that. There's no innocent parties, Mr. Albright. It's just you. This is an alter ego of you. We're going to take the assets out. And that was confirmed in the AZ, Lano, Kosnick, and especially the Olmstead cases. The Olmstead was probably the premier case on single member LLCs, Mr. Olmsted has ripped off a lot of people, and the FTC is after him. He's got $10 million sitting in a single member LLC and going, Judge, you can't touch this, neener, neener. And the judge says, look, Mr. Olmsted, there is no innocent parties. Single member LLCs don't provide charging order protection. And as a result of that case, the Wyoming legislature met within just a few weeks and went, oh, single member LLCs are good in our state. We'll give you charging order protection. So Wyoming created great new statutes. Since then, Delaware, Nevada, South Dakota, and Alaska followed, and they've said, we'll give you asset protection for single member LLCs. But the other states haven't followed with those statutes. The second thing that we look at is, besides the number of members, we also look at the state statutes. We want a state like a 5-star. Our organization has ranked these state statutes, and we give it either a 1-star, 2, 3, 4, 5. 5 means they cannot foreclose. The judge cannot foreclose on your interest. The charging order is the exclusive legal remedy that somebody has against you. A 1-star, the state goes, yeah, you could foreclose if you really wanted to, and in between is sort of, in between. And so what we do, we've spent hundreds of attorney hours and paralegal hours looking at every state statute, and we compared that limited partnerships against LLCs, and we've got that in our new textbook. In the back in the appendix, and where we go through and we compare state statutes, which ones protect single member LLCs, which ones don't. Okay, another thing that we, again, let me kind of give, let me kind of discredit why most accountants are not real good at what they do. The most common question that we get in customer service, and that I get at least, is, okay, I'm a real estate investor. What's the best legal strategy for me? And they're looking for just an all-encompassing solution that will solve all of their problems. And my answer is always, it depends. Do you want to hold or flip the properties? Do you want to hold the title or the note? Are you using IRA funds, 401ks? Are you using your own funds? Are you using leverage, or are you paying for everything cash? Are you using other people's money? Are you a U.S. citizen? There's so many questions. Let's just break down the very first one, which was, do you want to hold or flip properties? And because the concerns are so much different, the strategies have to be different. If you're holding properties, yeah, I'm worried about tenant safety and property managers and maintenance and protecting equity. We kind of went over all these things. I want a simple process of doing this, not 27 bank accounts. And I'm worried about due on sell clauses and depreciation and passive losses. If you're using the wrong legal structure, you're making money in 5 properties but losing 1. We want to offset that. If you've got the wrong legal structure, the IRS will deny your passive losses, so you can carry it forward, but you can't use it to offset the income right now. But if you're flipping, the concerns are so very, very different. Now I'm concerned about construction liability, subcontractors not getting paid. I'm worried about buy and sell agreements, capital gains, dealer status. If the concerns are different, you would expect then the legal strategies for protecting it would be different. And remember, I only broke down one of these questions. So as much as I would like to say, well, here's the way to win, the analogy we always use is, if you're playing chess, there's not just one plan that wins every time. We're here to teach strategies, and I know that frustrates a lot of people. Well, just tell me what I need to do. Well, the answer is, well, it kind of depends on so many things. There's 2 definitions that I really need you to understand before we get into case studies and before we get into drawing diagrams and showing how we do this. One is corporate veil, and the other is charging order protection. If you don't understand this, everything from here on out will kind of get dwarfed, and I'll kind of lose you. So corporate veil protection is to protection from, it protects you from the business. Let's say the business gets sued, or the assets get sued, the rental property gets sued. The lawsuit happens right here in your business. The goal here is to build a brick wall, pretend brick wall, so that they can't come after you as the directors of the corporation or the managers of the LLC or whatever. We want a brick wall for you and your personal assets. And so we contain the risk. We want to contain the risk inside of the business, but don't let it come after you. So attract all the risk, contain it there. That's our goal. There are two basic entities that will give you good corporate veil protection, obviously corporations. Now, and limited liability companies. And that could be single member, multi-member, it could be, you'll notice family limited partnerships are not on that list because the general partner in a family limited partnership has unlimited liability. But corporations, LLCs, oftentimes, in most cases, IRAs have corporate veil protection. They can't come after the trustee. There's a few exceptions to that. But those are the entities we use that contain risk. Now, charging order is entirely different. And I'll tell you, most attorneys that I talk to and I've trained don't understand this. The lawsuit comes to you personally. Again, you either do something wrong or you're accused of doing something wrong. Either way, there's a judgment against you. And the goal here is to protect the business and to protect your personal assets from you. And the very best entities to do that would be multi-member LLCs. Remember, there's innocent parties. We put assets in a multi-member LLC, you get sued, they can't come take these away from you. That's good. Single-member LLCs are not on that list. Single-member LLCs, again, don't have charging order protection unless you're in one of those 5 states. So they're going to walk right. You get sued, they're going to come take the assets away. So multi-member LLCs, and again, family limited partnerships, because again, there's innocent parties. You'll notice corporations are not on that list because corporations, they'll come and take the stock of your corporation away from you, and then they've got the assets. So no brick wall for corporations, no brick wall for trusts, no brick wall for single member LLCs. The best legal entities that have charging order protection are multi-member LLCs and family limited partnerships. So let's talk some basic structuring here, and then we'll leave some time for questions. The way we like to set up most structures is a tag team approach. We set up a property management company. This could be an LLC taxed as a corporation or a true corporation. Your corporation will manage the real estate holdings, deduct expenses that wouldn't be deductible to the real estate owner. The multi-member LLC, remember, not single member LLC, because that's where the real estate is. That's where your equity is. That's the property management company really doesn't own anything. It just manages things. Your money is tied up in real estate, so we want that in a multi-member LLC. It's owned in separate legal entities with strong charging order protection from outside creditors. Now, what is between these two, there has to be a tie. Every time we're using multiple entities, there should be a tie between them. And what we do here is we use a management agreement that shifts all blame, all liability up to a management company. All repairs, all maintenance, all tenant matters, safety, welfare, liability, we're shifting away from the equity position up to a property management company that's got a little bank account, but there's not much there. Yes, there might be an employee or two. It owns a few reams of paper, some sprinkler parts, and a wheelbarrow, but maybe a beat up pickup truck, but there's really nothing of value there that anybody wants. Do you need the management company if I own the property? Do I need a management agreement if I own both companies? Yes, absolutely. You wouldn't hire an outside manager without having a management agreement. And most outside managers are not going to take on the liability that your corporation could. Your corporation, 100% of the liability, we're shifting by contract all the liability up to a management company. Now, let me be clear. If there were a lawsuit, most likely both of them would be sued, but the multi-member LLC would motion to dismiss me out. Here's the property management agreement. It's his fault. And I've seen that work time and time and time again. It works for Hilton. It works for Marriott. You're not going to walk into a Marriott hotel, slip and fall, and walk out owning the West Wing because the property management company is responsible. We're using that same concept to go, it's not my fault. It was his fault. It was his job to do the inspections and the record keeping and the bookkeeping and to carry the insurance. That's the basic theme. So what are the duties of the corporation? Well, it's the same as if you had a third-party management company. What would you, if you hired me to manage your properties, wouldn't you expect me to collect the rent and pay all the repairs and maintenance and carry adequate liability insurance? You'd allow me to retain a reasonable fee, keep property, bookkeeping for each one of the properties, and then you would expect me to write you a check once in a while as the owner. You would want me to do that. And I see this happen a lot. Well, I've got the management company, but I just keep all the money there. Well, that's not a third party transaction. And what you're doing is, if you're keeping all the money in the management company and never paying the multi-member LLC, then the courts could legitimately say, it's really just an alter ego. It's all one. There's no management agreement. You're not shifting money. There's no bookkeeping. If we're going to play this game, we have to play it as though we have a third-party management company and we're doing it right. All right. So what does the multi-member LLC do? Well, we really don't want you to do anything at the multi-level, multi-member LLC. We want it to be passive. We don't want you to manage the property. We don't want you to fix sprinklers. We want you to pay the mortgage, maybe pay the property taxes. It's okay to do. But if you lift a hammer to do anything at the multi-member LLC, then you've changed what's passive income, subject to not subject to self-employment taxes, to active income, which is subject to 15.3% self-employment taxes. So we want you to lift your pen and pencil, write checks, move money around, but we don't want you to ever do anything active. So what is the multi-member LLC? It pays the mortgage, pays the property taxes, major repairs, it retains or distributes income, it makes decisions like that, but it doesn't actively participate in the management because that's the role of the property manager. So what if I have multiple properties? Do I stick them all in one multi-member LLC? And the answer is it depends. I could. But what I could do is I could also have multiple LLCs managed by one management company. And that way I've got separation of assets from each other. Every legal entity, though, requires now a tax return, a filing fee, and a bank account. But it does separate the properties from each other. Or maybe it's a small group of properties with very little equity in them, and I'm separating the assets from each other. Okay. Well, I could do that, but if I do that, then I have 4 tax returns here, one for the corporation, one for each multi-member LLC, don't I? What if we can simplify that for you and still get complete separation but easier taxes? What I could do then is I could take the single member LLCs, single member, but not you, the member. Remember that's bad. I judgment against you. I take the property away. But what if I nest these single member LLCs inside of a multi-member LLC? Or it could be a single member LLC in a strong state like Wyoming, Nevada. You remember that. So single member LLCs, the beautiful thing of this structure, single member LLCs don't require a tax return. They're disregarded. So what I could do is the single member LLC, this number one right here, if this property is in Texas, I would file that single member LLC in the state of Texas so that I've got standing in the state. I can defend myself in court. I can enforce contracts. I can show up. When I show up, they don't disregard me because I'm filed in the state. So the property would be deeded in this Texas single member LLC, but the Texas single member LLC, the owner of it, the member, is this multi-member LLC. Now, if somebody comes against me, they got to fight me here because I don't own any properties in my name. I own a multi-member LLC or in a strong state. Now, when I go around and I go down to number two, this property happens to be in Alabama. So I would file a single member LLC in the state of Alabama, owned entirely by this hub in the middle. I go to the next one. This one's in Indiana. So Indiana single member LLC. I've got standing in the state. All comes down to here. If I've got any taxable events, and I will, they'll all come out of this multi-member LLC's tax returns. I'm not disregarding the taxable events. They just pass through to the multi-member LLC. All right. So where are the entities filed? Again, the single member LLCs would be filed in the state where the property is located. The multi-member LLC would be filed in the strongest state for me, and that might be where I live if this is simple. If it's a multi-member, if you've got good straight. If I'm looking for anonymity, I really have three choices. I have Delaware, Wyoming, Nevada. We like Wyoming. It's cheaper and has great laws, but Vegas is attractive. If I ever had to go there and meet with my resident agent, there might be a reason why I went there. The property management company, because you're hanging out a shingle, you're advertising, you're interviewing prospective tenants, that one has to be registered wherever you're doing property management company. So single member LLC is filed in the state where the property is located. The corporation is any state it's conducting business, and the multi-member LLC in a really strong state. All right. Taxation of the entities. The property management company will most likely be a C or an S. The single member LLCs are disregarded. The multi-member LLC is taxed as a partnership in most states. However, there are 9 states that are called community property states. In a community property state, the husband and wife are considered one person. And so let's say I lived in California. The community property states would be Washington, Idaho, California, Nevada, New Mexico, Arizona, Texas, Louisiana, and Wisconsin. Those are your 9 community property states. In those states, husband and wife, one person. So I could have in that hub in the middle a multi-member LLC, but it would be taxed as a disregarded entity. Everything would show up in your individual 1040. Now, that's all I prepared. I actually cut out so many slides so that there would be time for questions. There's so many things I didn't cover today. How do we tie this then into an estate plan and take your interest at the LLCs and the corporations and tie that down to avoid probate? I didn't cover that. We can cover that in Q&A if you'd like. How do we build anonymity into your plan? Again, I mentioned Delaware, Nevada, Wyoming could have complete anonymity. Except you gotta be careful, because if there's a mortgage, that's a matter of public record. We didn't talk about ethics and when can I really do asset protection? When is it just simply fraudulent to do it? So we ought to, a good plan ought to cover ethics strategies, strategies to avoid being sued. Besides just having good asset protection, there are some smart things and then some dumb things that people do that really attract lawsuits. Strong operating agreements, and some of the clauses that really should be in a really good operating agreement. The proper use of land trusts. We didn't cover that tonight, although land trusts are a very, very um, important thing for real estate investors. We didn't talk about tips for getting financing and maintaining your legal entities and using other people's money. And there's so much we didn't cover. Can we just, I just would love to have, if you're new to us, you're invited to attend the 3-day Asset Protection Summit. If you can't make it to Phoenix, which obviously is our next event, or you don't feel comfortable traveling, that's okay. We're going to teach it 2 more times. Orlando and Vegas. For information, go to protectwealth.com. Wow. That was a lot to stuff into an hour. So Kendall, let's, I'm going to rely on you. I really have not been paying attention to questions. And so let's open
That
this up.
went fast,
Kendall,
though.
can you help me kind of go through and answer some questions?
Yeah, that went amazingly fast. I'm
Kendall, are you
impressed,
there?
Don. I am. Can you hear me okay? Oh,
I
maybe
guess
his
not.
audio's not
Okay,
working.
so let's see what I can do. You wouldn't be considered, oh, we did that. Awesome, thanks. What happens if it delays till next year? Okay, so Al is asking, what if I can't get I'm trying to claim the depreciation or the cost of repairs all in the first year. I think I answered that. You could roll that into next year's taxes. Even though I expensed it this year, you don't get to claim it until next year if you can't put the building in service by then. Do substantial repairs need to be amortized? Keith, that's a great, and no, that's the beautiful thing about this new Trump tax law, is I can claim repairs usually up to about $1 million right now this year without amortizing or depreciating it over a period of years. That's exactly right. Can a new roof be expensed in the current year? And yes, again, the same thing. That would be a repair under most circumstances. And so again, if the building is in service, yes, that's exactly what we want to do. Arena, please show the previous slide. Let's go back. I'll show you the slide on section 179 deductions. Right here. All right, what's the definition of a real estate professional? Okay, I touched on that real briefly, but basically you need to have 750 hours of documented time doing real estate, and especially if you're going back and trying to wipe out the taxes you paid over the last 5 years, you might have a little fight with the IRS, and they might want to look at your documentation and go, yeah, no, we're going to disallow this one, and this one. And so I wouldn't suggest you come into that audit with 751 hours documented, because they're going to look at this with scrutiny. And if you got 749, you're not a real estate professional, and they are very picky about that. Come into that audit with 800, 850, something, whatever, but expect that there's going to be a little kickback on that. So document more. So 750 hours, and it has to be more than anything else you did. Let's say I've got a W-2 job. I did 40 hours. A week at my regular job and 750 hours, which I really spent a little bit more time on the W-2 job. No, you have to spend more time there than any other business activity. So those are the 2 major requirements, and I'm sure there's more, but those are the 2 that you kind of have to pay attention to. Okay, Toby, I'm not a real estate professional. How will I be able to deduct the rental income on my loss on a return? Well, luckily, Toby, you don't have to this year. What we were talking about here, to be a real estate professional, is this carryback loss thing. But no, that may not apply. If you can't apply it to be a real estate professional, you can still deduct repairs. We were just talking about the CARES Act and the carryback losses. Hey, Kendall, are you back on with us yet?
I am. Can you not hear me, Don?
I guess not. Okay. Don, I have one rental home and W-2 income plus 1099 from being a real estate agent. I tend to pay a lot in taxes. Would I qualify for the 2020 CARES Act relief? Rosie, again, if you're not a real estate professional, now you're real estate agent, that's real estate related. Okay, that's good.
Testing.
W-2 income may, if you're spending more time at your job than you are in real estate, the answer would be no. Toby, again, if I have only one rental property, do I qualify for the 1099-A? I think I've answered that. Type it in again if I didn't, but I think I did. Would you please give us an example of when cost segregation can help with our taxes? Yeah, I can give you that. Let's say I've had real estate for multiple years. Now that we come, but my accountant, and they're not stupid accountants, this is what they do. The cost seg is a really specialized area of the tax code that most accountants, most CPAs don't do. It really requires an engineer to come in and look at the property. But how would it help you is if we could speed up your we can look at properties. We look at your properties and go, well, yeah, we got some countertops. Even if you're 3 or 4 or 5 years into a depreciation schedule, if they can speed up that, give you that depreciation schedule, give you a bigger deduction right now, that gives you, again, more money to invest in real estate. And you become like the old Monopoly player where you keep all your money on the board in houses. Money sitting in front of you may not be making you money in the Monopoly game. You got to keep it on the board in houses and hotels. Hopefully that makes sense. All right, let's go on. Toby, would you please let us know the difference between real estate professional and dealer? I'm a professional. Am I a dealer? No, the dealer means that you're flipping houses with the intent to make a profit. I don't know why you would flip a house if you didn't have the intent to make a profit, but when you're a dealer in real estate, let's say I'm trying to hold properties. I got 3 rental properties over here, and I'm also flipping this one over here. What the IRS says is because I'm flipping, now I'm not eligible for depreciation on any of my properties. I can't do a 1031 exchange on any of my properties. I can't do a deferred sale on any of my properties, which means, let's say I'm trying to sell a house. I flip the property and I take payments over 5 years. The IRS is going to say, you have to claim, even though you're not going to receive the money for 5 years, you have to pay the taxes on this capital gain right now this year. Short term, long term, doesn't matter, because you're a dealer. And then also all of your income is subject to self-employment taxes, 15.3%. Even if that flip took a year and a half, anything over a year, remember you should be getting long-term reduced rates. But it doesn't matter because you're a dealer in real estate. Now let me maybe clarify that a little bit. A lot of people think that, well, I only flipped 1 or 2 houses, so I'm really not a dealer. Again, dealer status is based on intent. What I think they're thinking, and the accountants are thinking, is you probably won't get caught if you're only flipping 1 or 2 houses. And that is probably correct. You probably won't get caught. I flipped a house a few years back. It was in a cul-de-sac. It was across the street. We thought it would be a bigger house for our family to live in. We bought it kind of sight unseen because we couldn't get the tenants out, and we had to foreclose on them, but the deal had to be done before we foreclosed on them. We bought the house, foreclosed on them, then we went and looked at the property, and it ended up being like the money pit from hell. It was the basement we thought was finished was not finished. So we wanted to do that. The back stairs had fallen away from the property. We had to repore those. There was a crack in the foundation. We had to fix that. There were so many problems. The pets had destroyed all the flooring in the house. The countertops needed to be replaced. We were moving. We bought the house with the intent to move in, but it became very, very clear after getting into it. We couldn't afford to live in. We had to flip it. Our intent was not to flip. Our intent was to buy and hold and live in it. So we're not a dealer in real estate, even though we flipped the property in 5 or 6 weeks. We got it up and back on the market and sold it. But we're not a dealer in real estate because our intent was not to do that. But if you're buying a property with the intent and you're holding properties on the side, the IRS could label you as a dealer. Now that's irregardless of whether you're a professional or not. Dealer status and professional status is very, very different. Hope that makes sense. Mark or Toby, give me a call if not. Can the property management company be a member of the LLC? And Mark, yes, that's a very common way to do this. And in fact, there's a slide I didn't show you, and I'm not sure why that didn't come up. Let me see if I can find that. Oh, I know why. Because I hit it. I wanted to talk to you maybe about this concept about how to find the money. Because we were talking about multi-member LLCs and who could be the members. And the picture you see on your screen is a little leather three-legged stool. A one-legged stool will hold up, but anytime we add members, we added stability. A three-legged stool works better. A four-legged stool is even more stable, and after that, it doesn't matter how many legs we have. When we're doing a management company, could that management company be an owner of the multi-member LLC? Absolutely. Who else could be members? Well, I could have family members if I'm married. It could be a spouse, could be kids, it could be siblings, it could be family members. That adds stability. It could be my qualified retirement plan or an IRA. That could, if the IRA contributes 12% to that multi-member LLC, that could add stability. An HSA plan, my health savings account, if I could roll that over to a custodian that will allow me to self-direct it in real estate, that could become a member. My C corporation, again, the management company, that could become a member. I could use other people's money. I could bring in other investors or syndicated funds. Those are all options for who could be the multi-member. And again, anytime I'm doing that, I'm adding stability to that multi-member LLC. I'm adding innocent parties. Hope that makes sense. Okay. I got lost here. Kendall, are you back yet?
I'm here. You must have lost your audio.
So
but
sometimes when somebody types in a new thing, everything shifts on my screen. If I only have one rental property, do I qualify? Oh, I think we answered that. So if my management corporation is having a loss, can I switch the income to passive, from passive to ordinary? Well, we don't want the management company to make money. That is true. We want the management company to kind of break even and maybe a little bit of profit, but not a lot. We want all profits and losses to come down to where they're passive by nature. We don't want to carry a lot. Let me show you a slide that maybe will make sense. Is if we're moving the liability up to the management company, we're moving as much money as we can down to the limited partnership or the LLC that owns the assets. If you take money out at the corporate level, most commonly you're going to pay self-employment taxes plus regular taxes. We want to take the money out, or at least build our wealth down here in the family limited partnerships or LLCs. We don't want you to carry a lot of money in the management company, because that's where the liability is. So if the management company is having a loss, we want your losses to be down here in this LLC, this hub in the middle. That way those losses flow through to you. Most of the time, this management company is going to be a C Corp. There's times to be an S Corp, but the C Corp, that loss is going to roll forward to future years, and that's not necessarily going to help you. Will a recording of this be available? Yes, we are recording this, and hopefully it will be helpful for you. Don, could we hire a outside property management company? And yes, you certainly can. Let me show you how that would be done. Do I have a slide? No, I deleted it. Yes, you can have an outside property management company. When you do that, let's go to this slide here. When we do that, they're not going to accept as much blame as you want to give them. They're probably going to come in with their own management agreement, not the one that. So what's commonly done is you still set up a management company. But in your case, this isn't to manage properties, it's to manage your LLCs. You still hire a property management company, and that manages and does whatever it does. But now I've got my own little C corporation that manages my investments. It manages LLCs, and as a result, it gets a little management fee. And out of that, now I deduct 100% of my family's medical expenses. I deduct the business travel that I need, the education, the things that I can't write off anywhere else. My cell phone, my internet, my computers. But I'm doing that out of a management company that's not managing properties. It's simply managing LLCs. Hopefully, Kim, that makes sense. What about replacing aged heating air conditioning units? Yes, that would be a repair, not a improvement, unless maybe it didn't have central air and you've added it. That would be an improvement. I think the IRS would classify that. All right, I live in California, Mike is saying. Having an LLC in Wyoming, how will I justify that? Oh, Mike's trying to avoid the $800 extortion filing fee that California Franchise Tax Board has. And the Franchise Tax Board in California is different than any other tax board. They think if you're thinking about your property in Tennessee, you owe them $800 for your LLC, in Tennessee. They're totally aware that you're paying a resident agent and a filing fee and maybe a tax return in Tennessee, but the fact that you live in California and you constituted the act of thinking about, therefore you are conducting business in California and you owe them taxes. This one it gets a little bit more sophisticated, Mike, than I probably can cover. This is where come to the summit or call the hotline and we can help you with that. Arturo, if you have a single member LLC in a state where the properties are located and the multi-member LLCs like Wyoming and Nevada, which state do you file your property management company? Okay, so let's go back. Well, right here. I've got the single member LLC filed in the states where the properties are located, the multi-member LLC in a state like Wyoming, Nevada for good asset protection, and the property management company right there must be filed in any state that's conducting management activities. Hope that makes sense, Arturo. All right. And then we go on to Rosa. I have an investment property in California, single family home, adding an ADU and junior ADU, have a land trust in California, single member. What would be the steps I'd like? You know what, Rosa, give me a call. This is probably more complex than I can do with 150 students on the call. So why don't we Why don't you let me know? Okay. David is saying, we do hear Kindle. Oh, I just can't hear Kindle. So, and since I'm answering
You
questions,
probably
I
can.
don't know how to fix that. Kindle, if you have a solution, that
That's
would be
okay.
great.
It's okay.
Mike is saying, if I have rental income, $10,000, if my bonus depreciation is 11,000, can I offset the 10,000 rental income and the $1,000 from my W-2 income? Yes, as far as I read the question, up to $3,000, a loss in real estate can be used to offset W-2 income. So yes, I think that that's correct. Eddie, can you use S corporation instead of multi-member LLC for holding assets? So Eddie, let's look at the diagram that I've got on the screen. Could you use a LLC? Could you use a true S corporation instead of a multi-member LLC? Remember, the weakness of the single or the corporation is you own the stock of the corporation. If I sue you, you run over my kid, I get mad at you, I sue you, get a judgment against you. Can I take the stock of your S corporation? Yeah, there's no charging order protection for stock in a corporation. The answer is yes, I could take that. Now, if this were an LLC taxed as an S corp, then I have charging order protection. Even if it's a multi-member, I could even take a single-member LLC. The taxation really has nothing to do with it. Corporations don't have charging order protection, and there's an exception to every rule. The exception is except in Nevada. If I've got a Nevada corporation as a multi-member LLC, sorry to complicate this, but you're asking a question that has an exception. If this were a Nevada S corporation, then there's charging order protection. You remember the charge, the corporate veil. Your S corporation does indeed have corporate veil protection. It contains risk, but what it doesn't have is charging order protection. So could I take it away from you? Yes, I could. So it would not be a really good holding company. All right. Where do we get down to? So you can use multi-member LLCs for holding assets. Yes, that's exactly what we do. Rosa, what needs to be done in 2020 to be considered a real estate professional? I think I've answered that. 750 hours of documented time in real estate, and it has to be the major, business activity that you do. Tito, what if my single member LLCs are owned by a single member LLC instead of a multi-member LLC? Consequences? Okay, so let's go back to this diagram right here. If your single member LLCs are owned by a multi-member LLC, if this hub in the middle were a single member LLC in 45 states, I sue you, I'm going to walk right through and take that away from you. It has to be, it can be a single member LLC, but it has to be in one of the 5 states that recognize charging order protection for the single member LLCs. Remember, I showed you this slide. Those are the 5 states that offer charging order protection for single member LLCs. So Tito, if you're going to do that, it just needs to be a strong state. I don't care if it's single member or multi-member, if it's in a strong state. But in a state like Texas or Florida, great laws for multi-member LLCs, but sucky laws for single member LLCs. If that hub in the middle is a single member LLC, a judgment creditor can walk through it. So Toby, so if my income is over 150,000, can I deduct my rental loss? You can deduct rental losses against investment income, or up to $3,000 I can use to wipe out the W-2 income. The rest of it has to go against investment income. So I'm making money in the stock market. I got other real estate. I can you've got $150,000 loss. Only $3,000 can be used to wipe out your W-2. Everything else would have to be rolled forward. Arena, how do I protect bank accounts and investments? Put them in an LLC or living trust. Okay, let me show you a diagram that I used, but I really didn't explain very well. Well, you know what? I don't think I did use. Let's use right here. Some slides I didn't get to. What I could do, what's very common, is I hold my safe assets right here in the family limited partnership. This is where I put my bank accounts. We like family limited partnerships for safe assets, for brokerage accounts, for gold, silver. We like those things in a family limited partnership. We think that there's some nice tax advantages and a lot more court history for family. Remember, the new kid on the block is the LLC, and the family limited partnership has been around for 102 years in the U.S. So we like that. That's where we think that you should put your big bank accounts. Always keep a small bank account in your revocable trust or in your name, enough to pay your bills, enough to stay afloat, enough to, I don't know, just do what you need to do. But big bank accounts, brokerage accounts, things like that, we'd like to have in a family limited partnership. The other alternative to that would be to put it right here, the multi-member LLC. Arena, let me ask you a question. This single member LLC, the little satellites around, they own unsafe assets. A lawsuit against them could take out potentially everything inside of that legal bubble. That's why we're separating the legal bubbles from each other. But this multi-member LLC hub in the middle, does it own safe or unsafe assets? And the answer is it doesn't own unsafe assets. It owns a bank account, brokerage account, and interest in other single member LLCs. So in theory, even with this diagram here, the multi-member LLC could hold bank accounts. That might be a really good idea. Okay. Eddie, how can we contact your company? Oh, protectwealth.com. We're a training company. This is what we do. So protectwealth.com, our phone numbers are all over everything. 800-276-1430. Kendall, would you mind typing that in? But that's being contact for our phone number. Is there a limit on the W-2 $3,000 write-off? Yeah, it's limited to $3,000. That's all you can write. You can take investment income and only write off $3,000. So what we're looking to do, in addition to that $3,000, is now that you have a business, write off anything and everything that you can do. Write off your cell phone, write off your 100% of your family's medical expenses, write off your business trips, write off your internet. Even though you're limited to a $3,000 write-off, make sure that we're shifting as many activities, as many expenses as we can to business activities where they are tax deductible. Toby, set up a single member LLC in Missouri which holds the rental property. I live in California with my spouse. California is a community property state. Will the single member LLC become a multi-member LLC? Oh, in Missouri, no, it's not. A single member LLC is only going to be owned by one individual. The single member LLC, right here in this diagram, is going to be held by the hub. That single member, let me read that again. Oh, you're talking as though you don't have a hub, I think. So you own a single member LLC. It's a multi-member LLC in Missouri. It would be considered by the courts to be a multi-member, so it would have stronger asset protection. But because of the fact that you live in California, you could treat it as a disregarded entity because you live in a community property state, even though Missouri is not. Eddie, my S Corp is Nevada. No, I don't remember this. So I hope we answered that as we went through. Barbara. Oh, hi, Barbara. Can you explain the benefit of having a Wyoming holding company What form? Corporation, LLC, in the C Corp trading company owned by the Wyoming Holding Company. Why would I do this? Okay, so why would I take, let's say, 10% of this hub and give it to the management company for services to be rendered? Because let's say I've got a lot of expenses I need out of this management company. Oh, dang, I've got a lot of health concerns. I set up a medical reimbursement plan out of that C Corp, and I've got a lot of medical expenses. I need more money than an average 10% management fee would. So now it gets 10% of the management fee plus 10% of the income out of oh, okay. Or let's say, I'm gonna do a lot of travel. The flexibility of this is amazing. If I were at a young age and I just want to build wealth, I would keep my management fees very, very low. I want to build wealth down below that management level line where it's passive. I'm building income. I'm building, stock portfolios. I'm building, but at a later age of life, or when I have more medical expenses, I want to increase the management fees and maybe give the management company even an interest in the LLC so that I can spend more money that's tax deductible above the line. Barbara, great question. I hope that answered it. Al is saying real estate professional, 750 hours can't include bookkeeping and financials. You know what, Al? I don't know the answer to that. That would be a good question for Scott Estel next week. Let's ask him. Henry, what qualifies toward the 750 hours? Viewing homes, yes. Education, yes. Running numbers. Again, I don't know about bookkeeping and financials. If you're doing it on real estate, I would assume so, but that would be a really good question for the former senior trial attorney for the IRS. Okay, we're running out of questions and we're running out of time. So let's finish these up. So Tito, so if single member LLC is sued, the property may still be taken away. Yes, Tito, in this case, okay, so let's look at single member LLC number 4 right over here. It's got 3 properties in it. We put 3 properties in because I got very little equity. They're all in the same state. I put this over in Georgia because I got 3 properties in Georgia. Put all 3 of them together. Could one property take down all 3 of them? Yes, because remember, I've got corporate veil protection. Anything that happens, I'm containing that risk inside. Now, one argument is I want one separate LLC for every property that I own. Okay, well, that's good until you end up with 300 properties, and then it becomes just kind of ridiculous. That's when we start grouping. Well, I don't know when, but not certainly before you get to 300 properties. But this is where we start grouping properties, and the average wealthy person with assets over $10 million, I've found, my experience, is about $300,000 is where most of them fall. Anything over about $300,000 in equity is at the time that they set up a new LLC. But is there inside risk? Yeah, absolutely. That's why we carry good insurance. That's why we separate the assets from each other. That's why we manage equity. We try to keep the equities low. This is inside. Yes, there absolutely. That's exactly why we're separating the assets. If there was no inside liability, we would put all of our rental properties all in one entity. So is there inside liability? Yes, absolutely there is. All right, Greg, can a multi-member LLC contain only a husband-wife team and still be protected from lawsuits? And Gregory, that's a really good question. And the answer is yes, it can. Would it be stronger if I brought in another party? Again, like the little stool. If we're bringing in children and we're doing some estate planning, if we bring in children and bring, do, some income shifting, we bring in a child, we bring in a brother because he contributed $100,000. Anytime you're adding stability, it will add strength. even in Wyoming, Nevada, Delaware, Alaska, South Dakota. However, does it work? And the answer is yes, it does. But could we strengthen it? Yes, we could. And I feel comfortable with just me and my wife. I haven't brought my kids in because, frankly, they can have the crumbs off the table after my wife's taken care of. So I haven't brought in my kids, and a lot of wealthy people don't until it gets to the estate plan. But that takes away all argument that it's just an alter ego of this couple. So Gregory, yes and yes. So if Tito again, so if a single member LLC, yeah, I think we answered that. Yes. If property owned by the single member LLC, which is owned by the multi-member LLC, and someone sues the single member LLC, the property may still be taken away. Yes, I think we answered that. I'm in Canada. Would you recommend any lawyers there that have similar expertise? Kim, I wish I did. The concepts that we taught, though, work, but we're not going to use LLCs in Canada because you don't recognize LLCs. You have limited partnerships, that's okay. But the concepts of separating assets are different. You have different kinds of corporations. And your trust, even though it's based initially back on old English law, the trust your trusts are worded differently. Your probate process is worded differently, and so your entities are different. However, the concepts that I've taught about using the corporation to give you tax advantages, we're separating assets from each other, everything flows down to the living trust. The basic concepts work just as well in Canada as they do here, but the legal entities will definitely change. Henry, if your W-2 income amount are greater than 10 or 100,000, 200, 500 effect, your ability to take the $3,000 right. Okay. Again, what we're doing, I think you're limited. Let me go back to that one slide because I tried to be as clear on the slide as I could be on carryback losses. Persons who qualify as real estate professionals in 2020. And it doesn't matter if you qualified in 19 and 18 and 17 and 16, although we might get some clarification from the tax court on that. But if you qualify this year, regardless of whether you qualified in previous years, I can go back and claim all taxes I picked up or I paid on W-2 income, 1099 investment income. And I believe that it's still limited to $1 million. So, Henry, this is the best way I can answer this question. And remember that Scott Estel will be with us next week, and I think he can clarify if you have further questions. I just quoted that right off the IRS's website, so I believe it to be very, very accurate. So, with that, if there's no other questions, sorry I couldn't hear Kendall. I'm sorry. I hope we got to the questions, and I very, very much hope that this has been helpful. I have to tell you, I love real estate. I love investing in real estate. I'm not like Aaron Adams, and I haven't made millions, but I love investing in real estate. It is how America's wealth was created. Please join us in the upcoming seminars. If you can make it to one of the summits, wow, we got questions. Why don't you call the hotline? We're over time. The hotline number 800-276-1430, and I'll be happy to answer your questions tomorrow. Thank you for your nice comments. I appreciate those. Have a very, very healthy, stay healthy, and productive future. Thank you for being with us. Have a great night.